Hey, welcome to the podcast. Thanks for joining me. It's a new week. The stock market off to a rough start this week. Dow Jones finished down about 62 points or so. The NASDAQ was down about 11. The S&P was down 5, all about anywhere from about 1/3%, pretty much across the board. The Russell 2000 actually held up better than the other indices, so it really didn't feel like kind of that real fear-based sell-off that you would expect. There's plenty of S&P stocks up, plenty of NASDAQ stocks up. Treasuries actually didn't even really rally on the day, so treasuries were flat, which you would expect. Again, that risk off means money coming out of stocks going into treasuries or someplace safer. Didn't see that today, so you saw more profit taking, I think, instead of a real rotation out of the market into some of these safer places. The volatility index was at a little under 1387, up about 2%, so not a big jump there either. And, you know, if we look at the S&P 500, you can see it's had some trouble at these kind of newer, higher levels. And one has to look at this and wonder if it's simply going to kind of do this drifting sideways. Had a little bit of sell-off and then up to another level. Now we're drifting sideways. Does it come down a little bit and then we shoot off higher? And until the pattern's broken, I would say that is what's going to happen. You know, now one interesting thing today was the Cyprus news reaching some type of deal over the weekend. The futures were up this morning. The stock market popped at the open. In fact, if we take a look at the 5-minute chart, you saw the big jump up at the open, and then, I mean, literally within just a few minutes, it started to roll over, and we headed down, had a little rally, fell down even further, had a stronger rally, and then fell off, and then, of course, rallied to the close. But the bottom line was you saw this deal, and for those who thought we were going to get this huge relief rally, the question was, what was the relief going to be from? Because if you go back to the daily picture of the S&P 500, what you'll notice is that the stock market hadn't really been selling off on the Cyprus news. You know, we had a little gyration and more of a pause in the buying. So why would it have rallied on that news? And so I think initially it got this jump up and then sold back and kind of resumed what it would have done had we not ever heard of Cyprus, you know, a week and a half ago. But what's happening right now is it's obviously there's this tug of war going on near the old highs. And if we kind of flip over to the Dow Jones, which we haven't looked at in a while, again, same type of pattern that you've been seeing in the S&P. Have a little sell-off, little rally, little sell-off, comes up. And then, you know, in February, we just went sideways, had a couple of down days up to another level, kind of the stair step. So now here we go. We're going sideways a little bit. We may go down a little bit, but I would expect, again, a continuation pattern simply because until proven otherwise, right? That's the deal. So, again, if you come into today and you wanted to buy and buy the gap open, you lost money. On the other hand, if you're looking to take profits because you're kind of going, uh-oh, here it goes, and now it's got to pull back. Remember what happened at the end of last month. The stock market sold off really for a couple of days, looked like it was going to roll over right in here, and then literally came back and erased all those losses within a couple of days, and we went up to this new level. So be careful about taking profits too quickly because the dip buyers have tended to come in. And again, we're not seeing the tendency to sell stocks and rotate into these safe risk-off assets. That's just not happening yet. And its evidence is when you look at things like, if you even look at some things like junk bonds, you know, they're moving sideways. They're not really selling off heavily. And, of course, we mentioned the treasuries. Treasuries should have rallied today, and they didn't. They actually were up a little bit, and they gave up most of their gains, not a lot of volume on it. So, again, the bottom line is that we're not seeing the intense selling yet. Things are stretched. Things are where you should have some caution, and maybe if you were looking to buy, you go ahead and you wait. And now, if you're severely underinvested, then you have to use these types of days that we're seeing, these slight pullbacks to add to positions or get some of that cash invested. But if you feel fairly comfortable, but you're wanting to maybe take it up another level and get more long or more invested, then I would just say wait, because what's happening is you may get a better opportunity. There's no sense when it's kind of a 50-50 deal right now. If you feel more comfortable, wait for the breakout. Yes, you're buying at higher prices, but you're getting that confirmation. So that's what's going on really with the overall stock market. Overall, I'm really not doing a bunch of things right now because the odds of getting whipsawed are kind of high. And again, what's happening is the market's going to start focusing on, it's been worried about Cyprus. It's going to be worried about whether the Fed's going to take away stimulus or not, which they're going to continue with that. That's a no-brainer. But the next thing is going to be earnings. We know a lot of earnings come from Europe, come from China, come from Japan, of these big conglomerate S&P 500 companies. So what are their earnings going to look like? What are they going to say? And remember, just to go back, if you missed the last podcast, we talked about FedEx. That's why this big drop here, because they had some cautious things to say. Very cyclical international company. You flip over to something like a Caterpillar, same type of thing. They continue to say some things that are negative, so it's going down. So let's watch that, because earnings season is going to be pre-announcements, and earnings season are going to be something that I think it's going to make the market move one way or the other. But once again, are we kind of in this Goldilocks scenario where, you have earnings okay, you have the economy okay, you have the Fed acting as if we're in a tremendous recession and pumping a bunch of money in? That could be the kind of Goldilocks scenario for stocks. And again, think about what's happening. Money continues to flow out of these other places. If you're in a European bank, do you really want to hold your money in a European bank right now, or would you rather hold it in a U.S. bank? U.S. bank. So what happens is money flows into the U.S. dollar. This is the ETF for the U.S. dollar, and you can see moving sideways, but had a good day today, up again, almost 0.75%. So that's helping us in the medium term here. Now, if we flip over, Apple continues to be the inverse ETF trade. As the stock market goes, Apple seems to want to do the opposite. So Apple did break out of this, and look, this is the first sign. This is what you want. Volume's been increasing the last few days. Didn't close at its high, but it is breaking out. I think you'll probably get maybe one more pullback, maybe to the 20-day moving average or something before it gets to where it runs away from you. It doesn't look like it's running away just yet. It was only up 0.33% today. But the bottom line is it does look like some of the selling has abated as people, short sellers, are looking for the next thing, the next big thing to short. And Apple's kind of it, because, or not it anymore. Because if you think about it, if you're one to short Apple, buying it's one thing. But are you really going to short this company with all this cash that's not very expensive? Again, you can debate whether there's other companies out there to buy, but to short, trust me, there's plenty of other worse companies out there than Apple. And in fact, just from the fundamental standpoint, let's take a look at Facebook. Facebook was one I had highlighted a few weeks ago and said, watch out for this head and shoulders pattern. And these little arrows are what I had pointed to. And it looks like that's exactly what's happening now. Because if you look at Facebook, it kind of was in this channel. It broke out. It stayed above it. And then we had this head and shoulders pattern. And now it's broken back down. So what you would expect from Facebook is maybe to go back and test the, let's call it 22, 23 level. And then if it holds there, that may be a nice trade. But from a fundamental standpoint, Facebook is kind of like Amazon. It's a lot of blue sky. Remember, Amazon was going up on a lot of blue sky back in the day, and maybe still is. Whereas Apple has real fundamentals. And yes, some of their growth is slowing. Some of their margins are slowing. So Facebook may look sexier and it may have more upside potential. But if you're wanting to go with something that's proven, the short sellers seem to be coming into Facebook, and it's not heavily shorted already, which means it's got more room to be shorted. But you could see Facebook continue down as the easy short trade in Apple may be over. So take a look at that. Transports, I wanted to bring your attention to something on transports. I have this RSI, which is a relative strength indicator. And the thing that I always look for is stocks or ETFs or sectors, whatever, making these new highs like this has been. And transports are at a point right now where they should rally if they're going to continue. But what you're seeing is this lower high. So this is a negative divergence where you have something going up, the prices, and yet the momentum, so to speak, is slowing down. You're getting these high, lower high, lower high. And so watch out for transports because they could roll over. Now, that doesn't necessarily spell doom and gloom for the market, but it was the thing that really broke out in late December and got people's attention because it was such a cyclical index, right? So if the transports are leading, something good must be happening to the economy. And we did see the economy obviously improve from what people's expectations were back a few months ago. And so once it broke out of here and kept going up, it seemed like the whole stock market just got a bigger sense of confidence. But now you're having this. So this is something developing. It's not, this could turn back up tomorrow. But just watch that, because that caught my attention today. And transports were one of the worst performers today, down 1%, underperforming the stock market by quite a bit. Remember, the NASDAQ, the Dow, S&P were only down about 1/3% today. And yet you had the transports down over 1%. So be careful. Watch transports, because they led us on the way up. They may be reversing here. They could be an early indication too of the whole market rolling over. But again, until proven otherwise, let's watch the overall stock market, and let's look to see, does it break this uptrend first? If we get some intense selling, we're in a kind of a tight channel. And if it does break that, how far down does it go? Does it go down to the potentially the 100-day moving average here? Here's the 200-day moving average. That's a more significant sell-off. These are sell-offs down in this range where people really question this rally and say it's got to be over now. And then that's the time where maybe you can buy some good quality things that have sold off. But if we just get a pullback down to the level of kind of the uptrend, then it's not necessarily going to be something that's going to be a screaming buy. But look, this is the spot it should rally from, because why? Well, this is until proven otherwise, this is the channel that we've been in. And channels don't always work, but they have been since post-election. So watch that. We're at kind of this inflection point, not the injection point, the inflection point, where we could break down a little bit here. So again, if you're looking to buy, wait just a little bit for some confirmation. If you're severely underinvested, then again, use these days as buying opportunities, but keep the watch list of things you've been wanting, and also those things that have gone kind of parabolic, that just seem like they have not given you any chance to get in, but you own them. Maybe for those other people that own those types of things, set your stops and maybe take some profits. And again, what's the worst that can happen? You may have to buy it back, a little higher, but I think protecting yourself is always the first priority. All right, guys, have a wonderful day. Don't forget to check out twitter.com/Karl Eggers. We're on Facebook, Google+, iTunes for the audio portion of this and video, and Google+. We're also on eggerscapital.com. If you're new to the podcast, thank you for signing up. Appreciate it. And feel free to respond with some questions, guys. I'd like to see the questions. I want to answer some of your questions you have, and we'll answer them in a future podcast. Thanks a lot. We'll talk to you soon.